Welcome to the B.F. Anderson Techno Fundamental Report for October the 3rd. Building a portfolio is a patience game. It's just something that takes time. I look back on my investing years, and gosh, I've been doing this for over 40 years, and I've just built my portfolio gradually and steadily. Now, success is not a luck, it's a game of patience and hard work. So what Gerald Loeb talks about in his book, Battle for Investment Survival, and I've referred to this many times, he says, my feeling is that an intelligent program aimed at doubling one's money might at least succeed in retaining one's capital or actually making a good profit with it. Loeb is very specific in his book about speculation that all investments have risk because an investment requires speculation. So back in the early years for me, I was basically dealing with things like utilities and S&P 500 type stocks, and I just didn't really feel like I was getting anywhere. So around 1995, I shifted gears and went into the growth stocks, and looking back on it, it was a good decision for me. Now, don't fight the Fed. Now, as we know, Jerome Powell spoke earlier this week. And my indicator, which is the power index, is telling me that they're going to continue to probably lower interest rates. That's the purpose of this indicator. What it's basically saying is that the free market, which is not controlled by the Fed, it's a free market, and this is the 5-year Treasury note, it continues in a downtrend, according to this indicator. Now, when Powell spoke, he basically said he's following two primary indications. One would be gross domestic income, and the other one is I'm sorry, I'm having trouble reading this, but anyway, the point is, you can see the graphs. I mean, they're really, on a macroeconomic basis, the economy is looking pretty good. So back to talking about building a portfolio, you don't want to do a cannonball in the pool. You want to move slowly. There's no rush. I'm just telling you, there really is no rush. So what we do is we keep an eye on a group of stocks, what we call our focus list. And we're looking for bases. And so when you get a breakout above the base, that's what we're looking for. So in other words, if you think about a proper base, what it means is that the buyers come in, sellers come in, buyers come in, sellers come in, until they reach what we call parity. But when you break out above the base, it's telling you that the buyers are taking over. So when we get a breakout above a base, we try to not pay more than 5% above that buy point right there. You just don't want to be chasing things and that are extended. Now, going back and looking at an example would be Tesla, which we got involved in 2012. I actually bought a Tesla in 2012 just to see the quality of the product, which we were quite impressed. But you can see here a long base, a real long base, and then all of a sudden in March of 2013 it breaks out, and that was at $2.50 a share, and the stock went up to 12.5. So that's all split adjusted, by the way. So if you also look at Apple, and this is kind of back to why there's not a big rush on this thing, you can see here you had a nice flat base, somewhat of a sell-off. This would have been somewhat of a shakeout in the form of a cup, but then you break out here above that base, and it really did well. Now, I did want to mention one that's really extended here. This is the Crane Shares China Fund. And, ever since China has announced that they're relaxing their interest rates and they're kind of stimulating their economy, there's been absolutely a blast off in these Chinese stocks. So again, you've got the base, but you're so far extended above the buy point that what I would do, and this is what I would watch for, is you want to see some consolidation. You want to see what we call a continuing buy signal. So you got your original buy signal here, but it jumped out so quickly that it just got extended. Now, I would say this is probably one of the most important indexes you could be looking at right now. This is the Value Line Geometric Index. Now you can see here, going back in 2020, there was a dramatic move in this index. Now this is a 1,700 stock index that's equally weighted, so it really gives you a truer picture of what's going on with, let's say, the average stock. Well, we all know that the Mag 7, the seven stocks that are in the S&P and the Dow and the Nasdaq have dominated the market, but I'm just saying from experience that's just not sustainable. At some point this market's going to need to broaden out. So the good news here is we're seeing a sideways action. So think about how frustrating this is. We make a bunch of money in Tesla, and then it comes down in a bear market in 22. Now remember, stocks like Nvidia went down 70% in this environment here. So, and the NASDAQ was down about 40%. So 2022 was a very difficult year. And at the same time, the Fed is raising interest rates. Well, we go into a consolidation here. Then we have what we would say was probably a shakeout here. Then we've rallied and we've held that rally. We've held it. And now we're breaking out above that box. So what this looks like to me is, and this is a very healthy sign, that the market is starting to broaden out. More stocks are participating. In technical terms, we call it breadth. So you want a lot of breadth in the market so that you have more than just 7 stocks running the show. That's just not a good sign. Now, the primary trend continues to be up. The S&P trend is definitely in an uptrend. The NASDAQ is definitely in an uptrend. Remember, the 200-day moving average is a very important level, and we're holding above it. Now, also, if we just kind of look at interest rates overall, this is the 2-year Treasury, this is the 5-year Treasury, and this is the 10-year Treasury. All these interest rates are in downtrend. So again, don't fight the Fed. They're going to probably continue to lower rates. Also want to note how oil prices, with this going on in the Middle East with Iran and Israel, you would really think the price of oil would be skyrocketing, but it's not. The thing about these wars is they've been fighting over there for 5,000 years, and they're probably going to continue fighting for the next 5,000 years. So trying to worry about the Middle East is just kind of getting to be an old story. I've been dealing with the Middle East story since, in the 70s when we had the oil embargo. The aggression index does look like it's trying to stabilize in here after a pretty dramatic drop-off. We're still not out of the woods on it yet. We need to get back above that moving average and start consolidating. So we're still seeing a lot of defensive stocks continuing to perform. Now, the other good news is that the new lows on the New York Stock Exchange have dried up pretty nicely. They're under 40 a day. We've got a good grouping here. So what this is designed to do is just simply say the sellers are somewhat drying up. So let's look at a couple of stocks that we're looking at. Now, I must mention we own this stock. I own it personally, and my corporation owns it. Our fund owns it. So you can see here you get that basing action, then you get that shakeout, which just seems to go with the territory. In other words, wanting to shake you out of the position. But then you get, boom, the breakout above the base, and now it's starting to trend. So what we're looking for is a solid uptrend, which this stock is definitely looking at. And it actually hit a new high yesterday. Then we also own, just recently bought Carvana, which is used cars. So again, you can see here we had this base going, and then it a little bit of a shakeout. Then we start moving sideways. The stock is hopefully going to break out above this base, but it does look constructive. So we own that stock as well. If you have any questions, please let me know. Thank you very much.